Welcome to the Money Show, your go-to source for smart, practical and powerful financial talk. Whether you are trying to crush debt, build wealth or just get a handle on your money, you are in the right place. I'm Kavita Thapliyal, and every week we break down the numbers, demystify the markets and give you the tools to take control of your financial future. So grab your coffee and your financial goals and let's talk money. Today on the show, we'll be obviously focusing on an investment-related topic, but also we'll be focusing on your portfolio queries. Just in case you want to ask any question, you can WhatsApp us your queries on our WhatsApp number, which is 8657974571. We also have an email ID where you can send across your question. The email ID is themoneyShow@etnow.tv. All right, so let's begin the show. And in an era marked by market volatility and economic uncertainty, investors are increasingly turning towards safer long-term financial instruments. Among these, the National Pension System, which is the NPS, and various insurance schemes have emerged as preferred choices. Now, with fluctuating returns from traditional investments and unpredictable global events shaking investor confidence, the appeal of stability, tax benefits and future security has never been stronger. This shift signals a growing preference for financial products that not only offer protection but also ensure a disciplined approach to wealth building and retirement planning. So let's decode all of this today. We are looking at investors opting for NPS and insurance investment schemes, which are usually ULIPs. What kind of strategy is this? Is it really good for you to be opting out of mutual funds or share market and shift your investments towards these safer investment options, if at all they are? Let's figure out all of this. I have with me Arnav Pandya, founder Money Edu School. Arnav, good evening and welcome to the show. So Arnav, how do you look at this particular trend? Because these investors are mostly those kind of people who are new in the share market, who are experiencing this kind of a movement or the cycle for the first time. And I have no idea about how aware are they about NPS or the investment products that the insurance companies offer, which is mainly ULIPs that a lot of people are considering. How do we understand this kind of a trend?
Good evening. So the way you need to understand it is to actually go down deep and see where your money is actually being invested. So you might say that, say in direct equities, you are getting an equity exposure, or say in an equity mutual fund, you're also getting an exposure to the equity market. But just because, say, there is an insurance policy which is, say, a ULIP, and that doesn't mean that you are actually not taking this kind of risk. Similar is the situation with the national pension system, because there also it depends on where your money is going. Because if you're allocating, say, a part of this to equity, which is an option which you get under the NPS, along with government bonds and corporate bonds and all of those. So if you are taking a higher exposure to equity, ultimately you are getting an equity exposure. So the way to understand where your investment is going is to drill down, see what is your final exposure, because that is going to determine how your money is going to perform. So take out the layer which is on top in terms of what is the fund or what is the name where you are investing, and look below in terms of what exposure you are getting. That is, I think, is the key to getting the first step right in this entire investment process.
All right. When we are looking at products like a mutual fund investment, NPS, and insurance investment-based products, they ideally have a place in your portfolio. All three of them can be allocated. And since we always talk about diversification, maybe not investment products in insurance, but maybe a pure insurance product that might cover the specific insurance need that you might have. But having said that, how much of a risk mitigation can happen, if you invest in NPS or ULIPs as compared to mutual funds?
See, it is not that uh, a product or a type of product has no use. For example, if you look at the NPS, it is a very good instrument if you want to plan for your retirement and you want to accumulate wealth, which can then be used to get a regular payout in your latter years. Similarly, when you look at insurance, insurance is a means for you to provide safety for your family in case the earning member is not around. So there are uses for each of these products, and there is a specific manner in which you need to use them. Now, the thing is that if you are using a product for the wrong reasons or with a wrong misconception, then this is not going to help you achieve what you want to do. So, for example, say you have an NPS where you have a mixed exposure in terms of equities, corporate bonds, as well as government securities. So, in this case, the risk element is lower than what you are taking as compared to a direct equity exposure. But the same thing can be replicated in a mutual fund also. So it doesn't mean that you actually are reducing risk because you are going to the NPS. You need to look at what is your exposure in the portfolio with respect to various instruments, because again, one should not compare wrong apples and oranges, because when you are looking at the NPS, it gives you an exposure across various asset classes. Similarly, when you should look at a mutual fund portfolio which gives you this kind of exposure, not just a single mutual fund, because then that comparison is not correct. Similarly, in case of ULIP, it depends on the kind of exposure you are taking with respect to the various funds that are being offered, and that determines your risk element. So when you are looking at the risk element, understand what you are doing and then position it along the entire risk reward ratio curve.
Uh, let's talk about investing in ULIP as compared to a mutual fund. How cost effective it is. Also because we have ULIPs which are aligned with, where the investment options these days are coming up, where you can invest in mid cap, you can invest in small cap. So, looking at the trend, we've seen these kind of feature packed ULIPs coming up in the market, and it has really gained investors' traction also. So, in terms of product design, in terms of being cost effective, and also in terms of offering, what is good where when we compare mutual funds and ULIPs?
So one thing is very certain, that you will not get the kind of choices that you get in a mutual fund in a ULIP, because obviously ULIPs are increasing their choices for their investors in terms of the various subsegments of the investment horizon where you can take an exposure, but it's not as exhaustive as what you will find in a mutual fund. Second, in terms of expenses, it depends from scheme to scheme in terms of ULIP, how much each one is charging. And more importantly, here the question is when they are charging or these amounts to the investor. A lot of expenses within the ULIP structure are actually deducted from, in terms of the units are adjusted or deducted when those expenses are made. So all these actually need to be added up. The question here is that if you are a normal investor who is actually investing for a specific goal in mind, and when you have an option of various mutual funds which are there, then there is also the question of a lock-in which is there. See, NPS has a lock-in where the money in your tier one account is going to be available to you mostly at the time of your retirement. Similarly, ULIPs also have a 5-year lock-in. This kind of flexibility in terms of lock-ins are not there in mutual funds with the exception of schemes like ELSS and some retirement funds. So when liquidity is an issue, or when you want to make these kind of changes, when you want a broader horizon, then you will find that there is a big difference when it comes to mutual funds and when you look at ULIPs, because the choice is infinitely more when it comes to mutual funds.
All right, Arnav, now let's focus on having all of these three products in your portfolio. How can one really align these three products with their goals? And when we talk about exposure given to each investment, how much of it should be really given? Because what happens is you need a different financial plan at every stage of your life, right? So, can these products be invested in the very beginning of your investment journey, or there's a specific stage when you need to enter or start investing in these products?
So the best way to deal with this entire situation is to ensure that you are very clear on your financial goals. Based on these financial goals, you can keep adding various products which you want in your portfolio. Secondly, the exposure to them will also change depending on your needs, the stage of life that you are in, and what you need to do ahead. So all these will keep varying from individual to individual, and that is when you can choose the right mixture as well as the right exposure for you, because there is no fixed figure which you can use over a longer period of time. So one, there is nothing wrong in having multiple kinds of products in your portfolio. According to me, that is also essential, because that is a way in which you'll be able to achieve various goals in an effective manner. Second is that do not get stuck on a certain percentage exposure, because that will also change over a period of time as your needs change. So keep all these factors in mind, and then you build your entire investment portfolio wherein what is suitable for you is what you have, not what is suitable for someone else, or not what is actually very popular in the market. If you follow these very basic principles, then you will understand that what you have got is actually helping you reach your goals.
All right, I think that's a lot that we've discussed about which kind of investment instrument should be your priority. But then let's also understand NPS and ULIPs and the volatility that we are looking in the that we are seeing in the market right now. How much of an impact it has as compared to a mutual fund? Mutual funds, obviously, the NAVs are based on the market movement, and if it's a specific sector or a specific theme related fund, the NAVs are adjusted accordingly. But then when you talk about NPS and we look at ULIPs, how does the volatility reflect in your returns or maybe in the NAVs?
So, I mean, if you look at it, the NPS and NAVs will also move in a similar manner as the way in which other NAVs are moving. Because ultimately, the exposure is the same. So, what you need to do is when you are, say, looking at equity mutual funds, then as a means of looking at a similar thing, you need to look at the equity part of the NAV for the NPS, because you will get an NAV for the equity component, for the corporate bonds, as well as the government bonds component. So all these things are separate. And ultimately, for an investor, it is the mix in the portfolio which will determine how their value moves. But you will see a similar kind of exposure in terms of, say, if you have uh, NPS scheme exposure mainly to large caps, then the large cap performance will determine the NAV movement of that particular fund manager. Similarly, when you go to the ULIP, the kind of fund which is there and the way it is investing, those NAVs will be affected similarly, and that will ultimately go and reflect in your final value. The thing is that unlike a mutual fund, for an NPS or a ULIP, people don't go and keep looking at these values on a daily basis, which is why they are also not very clear in terms of how these values move. But based on their final exposure, the movement or the impact is going to be similar to what you will see in a mutual fund. And this is where actually the fund manager's ability comes in, because if a fund is outperforming, then it is because of the way in which the fund is being managed. So that is what one has to actually look at.
All right, I think that will be all. Thank you so much, Anna, for taking time out and helping our viewers understand that volatility is not a problem, but then, yes, your discipline, your time horizon, and your risk appetite, which should be a determining factor in choosing what to invest, a mutual fund into or NPS or ULIPs. Thank you so much.
If you like this video, then like, share, and subscribe to ET Now.